Hi everyone, welcome to this last video for chapter 3. This one is on materiality. So materiality is this idea that there is some amount that's going to change the decision that the users would make about our financial statements. So materiality is really that amount or a specific transaction that would influence the decision of the users. So it's some sort of amount or a transaction or an event that would make a difference on how those users view those financial statements and the ultimate decision that they would make. It's important to note here that the emphasis is on the user of those financial statements, not what management or the audit team thinks about those financial statements. So let's say you're a creditor and you are really concerned that you are ultimately going to be able to get those loan payments back. You might be really concerned about the cash amounts or the current asset amounts, because that's what's going to ultimately determine whether or not they're going to be able to pay you back. So then let's switch gears and say you're an investor and you really want to invest in a high growth company that has year over year double digit revenue increases. You want to invest in research and technology. So those are the areas that you would be concerned. So our job as auditors is to plan the audit to have a materiality amount that is going to cover all of those users. So whether we're concerned about assets or whether we're concerned about revenues or whether we're concerned about research and development, we're going to plan our audit to cover materiality for all of those users of our financial statements. So how do we measure materiality? We have two different ways or areas to think about when we're thinking about materiality. So we can think about the quantitative criteria or the qualitative criteria. So the difference between quantitative and qualitative deals with numbers, qualitative deals with circumstances or things outside of the numbers. So thinking about quantitative amounts, so the absolute size. So let's say we find a $1 million error. So is $1 million, that absolute value of that error, important to those financial statements? We also might want to think about the relative size. So if you're talking about my personal bank account, $1 million certainly is going to be important and material to me. But if you're talking about Walmart, $1 million is going to be a rounding error. So that absolute size of $1 million for Walmart, considering the relative size, isn't really going to be that important or that material. Then we have the cumulative effect. So the cumulative effect is, so instead of finding one $1 million error, we find 50 $1 million errors. So the cumulative effect then is going to be $50 million. So is $50 million going to ultimately be material to the users of those financial statements? So those are the quantitative criteria that we might want to think about. Now let's think about the qualitative criteria. So maybe the nature of the item or issue. So anytime that we see fraud, that is always going to be material. So the nature of the item, so maybe the dollar amount of that fraud isn't material, but we have fraud happening at a high level of our organization where our CFO is stealing money. That's going to be material, even though the dollar amount that he stole isn't necessarily material. The next thing to think about are the circumstances. So let's say we find a $1 million error that on the quantitative side isn't really that material. However, that $1 million error made us going from having a small loss, to having a small profit. So that again is a little bit fishy. It doesn't bode well for us. So the circumstances of having an error that pushes us into a financial gain position is a qualitative factor that we might want to consider. The next is uncertainty. So a lot of things that happen in accounting and auditing are uncertain. So think about our allowance for doubtful account and our bad debt expense. We have to record that expense before we really know who isn't going to pay us back. So the uncertainty of those situations allow for or lend themselves to this idea of materiality. We're never going to know exactly how much that allowance for doubtful account is going to be, but we want to get within a good ballpark. So thinking about that in terms of materiality is another example of one of these qualitative factors. So the good thing to know as students just starting out is that materiality is ultimately a matter of professional judgment, and that judgment is usually handled at a very high level. So our first year staff is not going to be responsible for determining the materiality of a particular client. That's going to be handled at a much higher level. So it's not something you're going to have to set going in, but it's something you'll want to be aware of. How are we going to use materiality? Materiality gets used in three different parts or three different areas within the audit. So first, we use it in planning. So we use materiality when we're trying to say, okay, this account is important or this transaction we need to look at. So we use it in the planning to guide our substantive work and direct our attention to areas of increased risk and uncertainty where we're going to want to spend a little bit more time. We also use materiality in the evaluation phase. So as we are going about doing those audit procedures that we talked about, and we find various errors or differences, we're going to use materiality to evaluate whether or not we think that that item or issue is a problem and needs to be further addressed, or whether it's something we can pass on, live with, and move on. And then finally, at the very end of the audit, when we are wrapping everything up, we use materiality to make our final decision. So we're going to have this list of all the errors that we have found that have gone uncorrected. And we're going to say, okay, based on all of this information, do we think these financial statements are materially misstated? So we use materiality in the end of the audit to make that final decision about whether or not those financial statements are materially misstated. We have two different types of materiality that we're going to think about as well. So the first is our planning materiality, which is one number. So planning materiality is that one number that if our financial statements are off by this amount, that's going to make our whole financial statements misstated. Then we have performance materiality, which is also called tolerable misstatement. That's like the benchmark that we use as we're going about and doing our audit testing to determine whether a particular item or balance might be misstated. So when we're looking at individual account balances or transactions, and we have to have a benchmark to compare it to, that's where this idea of performance materiality or material misstatement comes into play. That concludes my discussion on materiality for today. I look forward to seeing you next week in Chapter 4.